Hello, and welcome back to the Rational Brit. The window is closing. In just 8 months, the rules of the crypto game change forever. The era of keeping a small, undeclared stack on a side exchange, or even on a cold wallet, is coming to an end. Governments, understanding they cannot ban the technology, are instead sealing off every single exit ramp. Their strategy is simple. Decentralization is fine, but cashing out will be a crime unless you have declared and documented every single transaction. I'm talking about the Crypto Asset Reporting Framework, or CARF, and the EU's DAC date directive. This is the financial dragnet that will make undeclared crypto a political, legal, and financial liability. We've heard the crypto maxis say, just keep it on your cold wallet and cash out P2P. Over the next few minutes, I'm going to explain why that strategy is fundamentally broken and where the last few rational exit ramps may exist post-2026. Part 1. The new financial surveillance. Starting with January 1st next year, the rules change fundamentally across the European Union. The UK, Australia, Canada, and the US are rapidly following suit. CARF and DAC8 are the crypto equivalent of the banking surveillance frameworks like FATCA and the Common Reporting Standard, or CRS. Under these new rules, all centralized exchanges and even some decentralized platforms that interact with fiat will automatically report your entire history to your national tax authority. This isn't just about sales. This dragnet covers sales and transfers, wallet balances and holdings, staking income and airdrops. All of it will be automatically tied to your verified identity. The most critical rational failure of this surveillance is that governments will gain an unprecedented ability to build a comprehensive history of your undeclared holdings. Once that data is cross-referenced with your declared income, any discrepancy becomes a red flag. The era of the undeclared stack on the side exchange is over precisely because the information flow is becoming automatic and global. Now let's address the persistent but deeply flawed argument, just keep it on a cold wallet and use P2P when you need cash. The rational problem with this strategy lies in the burden of proof, and it is the single most important legal hurdle you will face. If you don't declare your coins, they are considered funds from an illegal source, a form of tax fraud. Now, undeclared cash is untraceable, even with a serial number. The burden of tracing a few £1,000s of cash is high for the authorities. But crypto is different. Every single coin, except for privacy coins like Monero, is etched onto a public, transparent blockchain. AI surveillance, powered by companies like Chainalysis, is getting exponentially better at tracing funds. Your years-old, untouched cold wallet will still raise alarms the moment it moves. But here's the real trap. If you try to cash out P2P, the burden of proof shifts to the person receiving your crypto. They are the one who has to explain to their bank or tax authority where that crypto originated. If they can't prove the source of those funds, and they can't if your crypto is undeclared, their accounts get frozen. They face the questions, not you. This means OTC dealers and P2P counterparties in CARF jurisdictions, like the EU or the US, will simply vanish, or their commission rates will become astronomically high to cover the immense legal risk. That undeclared crypto on your cold wallet suddenly becomes unwanted, a financial pariah that nobody with a legitimate bank account will touch. So, if the regulated exits are sealed and the P2P options are crippled, where are the last rational exit ramps? It requires relocation and structure. 1. Northern Cyprus, the unrecognized haven. Because it is not internationally recognized, your home country has no legal recourse to ask for information. The government is actively discussing an asset peace law which, for a small tax, would effectively allow you to bring in large amounts of money, including crypto, with no source of funds required, providing a clean slate for investment into property or cars on the island. This is the simplest, albeit highest risk, legal loophole. 2. The relocation hubs, Dubai and Thailand. These countries are notable for not being on the initial CARF list. Dubai offers zero personal income tax and zero tax on crypto gains. If your crypto is clean, you can buy property and gain residency easily. For undeclared funds, the key is proper corporate structure. Paying yourself a salary from a legitimate foreign company for auxiliary jobs like IT support or HR can provide you with a clean, taxable income stream, a local ID, and a banking history. But beware, you are capped at a mid-level income. No $1 million salaries for market research. Thailand. While officially part of the CRS, enforcement remains slow and cash is king. Unofficial OTC dealers are still prevalent, offering favorable rates. However, recent raids and the eventual implementation of global standards mean this is a short-term gamble at best. The final rational takeaway is this. Cashing out large, undeclared crypto stacks is no longer a simple transaction. It requires leaving your home country, setting up a robust corporate structure, and incurring the real costs of compliance, lawyers, accountants, and residency. If you want to stay home and cash out into a first-tier bank like HSBC or UBS, it will require a legitimate, audited business structure to make that money look good on paper. That's the bureaucracy you must accept. This has been the Rational Brit. Thank you for watching, and I look forward to your thoughts in the comments below. Do you think this budget is a necessary evil or a political act of cowardice? Don't forget to like, subscribe, and hit that notification bell to join the rational conversation. Until next time, this is the Rational Brit, encouraging you to always question the narrative. Good evening.